Loan officers, branch managers, if your business has been stuck and you've been trying to scale it, but you can't seem to break through, well, today we're going to talk about 6 possible different spots where your business may be stuck and what you need to do to solve it. Hey, I'm DJ Christofferson. If you're not familiar who I am, I've been a licensed loan officer since the end of 2009. I've been a top 0.5% of producer. I've helped build a mortgage company by multiple billions in annual volume. And these days, I spend my time helping loan officers and branch managers scale their mortgage businesses so they can actually love the career that they got. All right, so let's talk about these 6 different things. They're called the 6 M's. And full disclosure, I got this from a mentor of mine, Alex Ramosi, but I'm going to adapt it to the mortgage industry. So the 6 M's to scaling. And we're going to spend time in each of these 6 different M's. And the first M that we have is actually more. So more. And really, it's a question is, why can't we do more? And what do I mean by that? Well, when you talk to a loan officer and a branch manager, is I often ask them, hey, what are the things you're doing to grow your business? Where are those last few deals that you got? And they'll tell me, hey, I got it from doing cold outreach, or I got it from referrals, I got it from my database, whatever it is. And then I ask them, what are you doing throughout the day to help grow your business? And they're not really doing much. Actually, they're doing pretty much everything opposite of the things that got them the business. And so for most loan officers that their business is stuck is that they simply need to do more of what is already working. And so if your day is broken into places where, hey, I'm chasing documents, I'm chasing conditions, I'm maybe messing around on social media, but you're not spending concerted effort every single day doing the things that you know that works. But before you do anything else, you need to do more of the things that work. You might not like those things, but if that's what's generating you the business, do more of those until you have the finances to get somebody else to do those things for you. And so for most people, as I mentioned, is that they could see their businesses double within 30, 60, 90 days if they simply spent more time doing the things that already work for them. The next one is market. Now, loan officers like to blame the market for why their business is not way where it needs to be, because they are thinking about, when the early 2020s, when the interest rates were in the 2s and 3s and business was falling from the sky. So they're blaming the market for why their business is not doing well. Well, that's a whole bunch of hogwash, because I know so many loan officers that have had their best years as the interest rates increased. So your business is not where you want it to be, not because we're the market, it's just because you're not putting in the effort that you need to grow. So you might need to work more than you did previously, but that's okay. And the good news is that very few loan officers are putting in the work that's necessary to grow. And so even though that the interest rate might be higher, even though that, there might be fewer deals happening, there's still plenty of business. And you look at the NMLS records, there are far fewer loan officers now. So while the pie might be smaller, there are far fewer loan officers going after that same share of pie. So if you're putting in the effort, and then when the business does get easier, the market does get easier, you won't just see a small growth in your business, you're going to see an exponential growth for your business. And another thing is, I talk to a lot of loan officers, and I remember, because I helped grow a mortgage company, so I talked to a lot of loan officers, in those early 2020s, and they were talking to me, they want to get back in the business. They were in the business pre-crash. And they're saying, hey, I used to be a great loan officer, but then the crash happened. And I heard that over and over and over and over again. So they blamed the market for why their business was no longer good. And they think they were a great loan officer. Here's a harsh reality. They were not a great loan officer. They were a product of an easy market. A great loan officer does not let a market get to them. They find ways to excel through the market no matter what. So while this might be the case in some other industries, this is not the case in our marketplace. We don't have that. We might have fewer deals, but the business is still there. All right, now let's go to the next, is model. This is a little bit different. And excuse me, model is, how are you going after getting your business? And a great example of this would be, is if somebody has the wrong model. Let's just say that they are buying leads. And buying leads, if you're buying online leads, this is a whole other game plan than going after, say, realtors or database or where you're trying to get referrals. The lead strategy is a completely different strategy. And loan officers will often think that, well, if I'll just buy some leads, I'll supplement my business by buying some leads and then I will get more closings. Wrong. It doesn't work that way because you need to be set up with the mindset, the systems, the cadences in order to capture the business and the longevity, because statistically, these aren't going to close for 3, 6, 9, 12 months. So you have to have the systems, you have to have the game plan, you have to have the money, because leads aren't cheap, especially good ones, and you have to have the time. So if your model is I'm doing leads, but you don't have these things in play and you're not ready for it, you're going to fail. You're going to fail. Or let's just say that you want to go after, now I don't recommend going after this, but let's just say you want to go after the DPA market. I'm going to use an extreme example here. But your company, doesn't have no products for it or very little. You're going to struggle. So maybe that you need to change your model. Or let's go into all these loan officers that wear trigger leads. Now this is going to be a big problem for those loan officers that were doing trigger leads and the mortgage companies doing the trigger leads, because their model basically is going out of business. So they're going to have to pivot. And if they're not planning ahead of time, well, when that happens, their business is out of here. All right, so what is then the next one? Metrics. Now, this one you could actually probably theoretically put higher, but I guess it doesn't really matter where you put this, but metrics. If I were to ask you right now, how many leads did you generate last month? You may or may not know that, right? And let me change the colors here so you can see a little bit better. But metrics are going to give you more information of what you need to do next. For instance, let's just say you have 10 leads. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. And you look at your 10 leads that you had from the last month, and how many of those, or let's say 60 days ago, how many of those did you close? Well, a lot of loan officers might know that. I had 10, or one of my 10 ended up going to closing. Okay, great. You know that metric. But how many of your 10 leads did you get to application? And you might, well, I might not know that. Okay, you're like, well, how many? You got to take a look at it. Well, let's just say you look into it, and then you had 4. You had 4 of the 10 leads that you got did not actually turn into an application. So what happened to those? Question mark, right? Here's an opportunity for you, right? That could be an opportunity. If you don't know how many of your leads that you got didn't turn into an application, your metrics are not, you don't have the data for you to know what to work on. Okay, but now you say you got these here, 1, 2, 3, 4, 5. You got 5 leads left. What happened to those leads? What if all of those leads were bad leads, low credit, no job, and all of that stuff? Well, that says that, well, out of the 1, 2, 3, 4, 5, 6, you had 1 lead out of the 6 that you have applications turn into a deal. So what can we do with this opportunity here? Well, I need to see is why am I having such a high concentration of bad leads? Maybe you look at this and these are coming from 2 different realtors, and those realtors are all giving you bad leads. Well, okay, maybe you need to talk with that realtor and say, are these the only leads that you have? Or do you have better leads? Or maybe you need to drop those realtors and get better realtors. You look at this one, okay, they gave you a solid one. Then you look at a couple months back and say that realtor that you got that deal from also gave you another lead that turned into a pre-approval, that turned it into a closing, right? So then what we need to do is that we need to go find more of these realtors. So we take that back to realtors. Look at this mess I got going on here. So we need to then do more of getting realtors like this. So metrics definitely usually leads to more. But we're not done yet. We need to figure out what we got going on here. Why are we missing these leads here? That's 40% of your leads didn't go to application. And who knows how many of them end up getting to closing? We have no idea. So then we have to look into our system and say, what are we doing wrong that these leads are not turning into applications, right? Because this is effort you got to get these leads, right? You had to, however you got them. But if we're not taking that from a lead to an application, we have empty data. And so for most times, loan officers is that they need to track their metrics. They need to find what's working well, do more of what's working well, and then drop the things that are not working well and focus on the things, doing more of the things that work well, right? Pretty darn simple. Now, let's go into money. Do you have enough money to do what you want? And to be honest, most loan officers, you don't really need a lot of money to make a lot of money in this business. Now, if you're buying leads, that's a different story because leads cost a lot of money, at least to get in the good leads and get in enough leads in order to get the number of volume you need to close them, plus the systems and all that stuff that goes into it. But money generally is not an issue for most loan officers. They might think it's enough money or it's a problem, but it's not a problem. Why? It's because I don't know where my cell phone is, but we all have a cell phone. We all have free social media. There alone, you have so many opportunities that you can use for free other than your cell phone plan and your internet connection and be able to connect online. And so money should not be an issue unless you're going to a team, which we're going to talk about that next. And you might not like the things you need to do is like pick up the phone and reaching out to a bunch of people. But if you don't have business coming in, you should have no shame on what you do to get business, as long as it's ethical and legal, of course. Last one now is manpower. Manpower is probably my favorite one. It's one of the most leveraged things you can do to scale your business. And so let's just say you are doing a lot of these things. You're doing more. You have a lot of leads coming in. You're tracking things pretty good. You're doing things pretty well right. I'm not saying you have to do it perfect. Nobody does things perfect. And then you're still stuck. What's the problem there is manpower. You need somebody or some buddies to help you in your business. That might be an LOA who can run your applications, can run credit, run finding, structure your deals. It can gather your needs list, send the needs list, chase the documents for the needs list. When you get conditions from underwriting, they're chasing all the conditions. How much time would that free you up? Is it going to cost you money? Yes, it's going to cost you money, but it's an investment because it's going to free up time for you. And then if that frees up time for you, what are you going to do with that? You're going to do more. Everything usually comes back to doing more. Branch managers, same thing for you. If you want to scale up, you need to have fantastic operations because if your operations are not dialed in, your loan officers are not going to stay with you. But it doesn't just go with operations. Yes, operations is huge because if you have a bottleneck in your process with your leads, with your applications, with your deals and process, but it also can go from a sales perspective. One big thing for loan officers is that they might have a database, or if you're a company and or you have your branch, you have all these, past clients and such, they're hardly ever touched. They might be touched with the CRM and automation, but that does not replace actual calls. That does not replace actual conversations. And you would say, well, I don't have the time to do it. My loan officers don't have the time to do it. Well, then get manpower and hire somebody to get those conversations scheduled for you or scheduled for your loan officers. You don't need to have the highest skilled person in order to make those types of calls. So manpower is the ultimate leverage, is because you can get people in place with the right systems and of course and all that stuff to leverage and improve your operations and at the same time to grow and scale your sales opportunities. So which of these 6 M's are you needed to focus on? I can bet 90+% of you, it's simply you need to do more. And then the rest of you, it's going to fall underneath the manpower. And then a few percentage of you, maybe somewhere in between. So if you found this valuable, do me a favor, give me a like, give me a subscribe, give me a comment, tell me if you agree, disagree, whatever it might be. I'll see you in the next video.